Welcome to this episode of Business Redefined. Last week we had a conversation with the Chief Economist for Africa from the World Bank on matters regarding debt distress and the outlook for the region. This week we are speaking to the Deputy Division Chief from the International Monetary Fund, that's Wenji Chen. And I began by asking Wenji about the moderate downgrade of the outlook for SSA from 4% to 3.8% in growth for 2024. Exactly what defines this moderate downgrade by the fund?
I think in general, 20 BEPS is relatively small. And if you remember, we also had an update in January for the world economic outlook. So overall, I think the main message still to take away from this report is that after 2 years of rather sluggish growth for the region, there are signs finally emerging that the countries are on the mend. And what I mean by that in terms of growth, we see 2/3 of the countries in the region registering positive growth this year in terms of the projection compared to 2023. But if you look more in detail, of course, there's a lot more heterogeneity. We see in particular all exporters for this year's growth projection have revised up somewhat. But if you look at individual countries, South Africa is performing only at 0.9%, lower than expected due to ongoing energy shortages and problems with logistics at ports and railway. And then you also see on the other spectrum really high growth countries like Senegal and Niger on the backs of coming online of carbon and gas projects. Overall, though, what we see is that more generally towards the medium term, we have that non-oil and non-commodity type of countries, what we call the diversified economies, performing much better, almost twice the growth rate compared to those that have commodities export as their main revenues.
How does the lay of the land look as far as growth for East Africa is concerned? The thing about East Africa and why I ask specifically this question is because the region is relatively diversified compared to other parts of the African continent, and therefore as the IMF downgrades the forecast for this particular region, what can we expect for East Africa?
On that in particular, I think many of the East African countries tend to be diversified economies. So those we see, in fact, higher growth rates performing, and much because of the structure of the economy, they're not as dependent in terms of oil shocks, commodity shocks, and in terms of the diversified base tourism that has actually improved after the pandemic. So we continue to see that trend. And in terms of the growth prospects, as I said before, in terms of the overall projections, those tend to be very much better compared to the commodities dependent countries.
In the recent past, we have seen escalating tensions in the Middle East between Israel and Iran. And I asked Wenji, what would this mean for Africa? And more specifically, would this further complicate the conversation we have already had around the funding squeeze, the raising of interest rates by the major central banks, which triggers constricted global market access for African economies?
Well, we are living in a shock-prone world, and I think that's part of, unfortunately, what is going on in many of the countries and are impacted by that as well. There are a couple of channels on which the countries in the Sub-Saharan African regions are impacted by those particular shocks in terms of oil price, in terms of supply chain, which we have seen back then with the war in Ukraine in particular, food prices, fertilizer prices. So those we're really looking out for as well in terms of the eventual impact because of the large incidence of food insecurity in the region. In fact, for this year, we are projecting 140 million alone being acutely food insecure. But to a bigger problem, living in this unfortunate shock-prone world, it also means that it demands more resources for these countries to react to these types of shocks. And unfortunately, the funding squeeze, which we talked about last year, is still very much ongoing, which is giving a lot of constraints to what governments can do in response to that. So that is worrisome to us in terms of their ability to respond, in addition, of course, to the constraints it puts on them to further spend on their development needs, which are also very large. So we're going back on this funding squeeze theme that we still see very much ongoing for the region. And let me just note here, it's really a confluence of both conjunctural factors like these shocks that you're mentioning, but also more in terms of structurally long-term factors. And part of that, for instance, is the official development assistance that has been steadily declining apart from year 2020 in terms of the pandemic relief, but we see really some of the lowest amounts relative to GDP of the region since the last 15 years. And I think these shocks in the Gaza region as well is contributing to a diversion of some of the aids, which might have come to the region instead. And so therefore, the authorities are grappling with the funds that they're getting in terms of the need for their financial assistance to address much of the shocks, much of the development issues. In our reports, in terms of the overall advice that we have is on domestic revenue mobilization. And by that, we don't just mean increase in tax rates per se. What we really put emphasis on is also broadening of the tax base. Now, how would you go about it? Well, there are a couple of ways, and we have actually an accompanying regional economic outlook note exactly on that issue of how we cut budget deficits without undermining development. There are a couple of main priorities that we recommend. One is to simplify the tax system. And the other is really to reduce very costly exemptions and loopholes to really broaden, therefore, the tax base and to discourage invasion. The other one is to increase tax compliance. And this could be done in a segmented way. And think about smaller firms, middle firms, and larger firms who all have different needs in terms of how to comply and with the tax system. And lastly, to leverage technology, to really have digitalization help us in terms of coordination with taxpayers to make more effective the tax administration that we can use in order to raise these taxes. And lastly, I think to your question on elections and the communication going forward with the population, there, one of our key advice is to build trust. And what do we mean by that is to have clear communication exactly of the tax plans, and also to show that the government is very responsible in using these tax money from the population on things that will help development, that will help the population, especially address the needs of the very poor.
Welcome back to this conversation on Business Redefined. We are focusing on the recent release by the International Monetary Fund, focusing on the outlook for Sub-Saharan Africa for 2024. In the second part of this conversation, I spoke to Wenji about the discussion on inflation and the outlook for the region. We have seen global oil prices are beginning to tick upwards. What can we expect as far as inflation is concerned?
So inflation for the region, for the median country, has really significantly come down. So we saw a peak towards the end of 2022 of close to 10% for the median country. Now in February, the latest is around 6% only. So that's very, very encouraging signs. About half of the country, what we see is there is still some room, hopefully going forward, for them to cut, and so there's again this downward trend that we see. Now, for the other half, there are a subgroup. Let's think about a third of those countries where we see there might be now opportunity for a pause in terms of their policy rates, and then for a select. Not as many, fortunately, we still see, in fact, rising inflation, double digits and going high up, where there is still much more concern and therefore need to be very vigilant in terms of the monetary policy tightening.
Foreign exchange has been a very topical issue across the continent in the recent past. We have seen strong rallies by currencies like the Kenya shilling, the Zambian kwacha, the Nigerian naira against the hard currencies, notably the US dollar. Is this driven by fundamentals, or do we have challenges lying ahead of us and this could potentially be a passing cloud? So I asked Wenji about the fundamentals informing this trend in the FX market.
Well, and more generally, I think in our last year's report, we detailed how much of currency depreciation happened in the region and against the dollar. And that had to do with the different timing also of monetary policy tightening, whereas we saw in advanced economies and other emerging market developing economies outside of the region starting to raise interest rates already. The countries here in the region were lagging a little behind, and that had to do with their monetary policy decisions, but also in terms of the transmission of some of the inflationary impacts, which the other countries also felt earlier. More specifically on Nigeria, we think that the recent stability in the foreign exchange market is very welcome. And this has happened amidst sequential reforms that certainly have improved price discovery in the foreign exchange market and also reduced distortions in terms of the transition to a more market-determined exchange rate. However, at the same time, maintaining this tight macroeconomic policy mix is very, very important in order to reduce inflation and ensure, in fact, that the Naira's pressure remain contained. Now, respect to foreign exchange interventions, as you might foresee here, especially by the Central Bank of Nigeria. Now, the fund advice has been that intervention is to be done only in select instances where it's temporary, very unusual type of movements and very sharp movements in particular to the exchange rate. And these interventions should be done on either side. If it's upward or downward pressure, that's temporary. And also the central bank should really seize the opportunity to accumulate reserves when possible and to rebuild those buffers. I think in Kenya's case, it's not the prescription per se, but I think the reasons for rallying in shilling also had to do with the Eurobond issuance that recently happened in February, and that then subsequently went towards some partial buyback of the Eurobond that's coming due in June 2024 of this year. And that has certainly led to market confidence improvements and also improvements in investor sentiments. And in fact, the February domestic infrastructure bond issuance was really oversubscribed, also by non-residents, so another sign of the confidence in the country. And then the subsequent resumption, therefore, of the foreign portfolio inflows into the domestic equity market and shows also the improvement domestic investor confidence, and also accompanied by strong remittances that have certainly led, therefore, to a positive development in the shilling.
Is the funding squeeze behind us? This year, at the start of 2024, we have seen Cote d'Ivoire, Benin, and Kenya go back to the global markets issuing Eurobonds for refinancing. But spreads are still large, and the question I asked Wenji is whether Africa can heave a sigh of relief and say that indeed the funding squeeze, which dominated the latter part of 2022 and the entire of 2023, is it behind us, or what lies ahead for the markets?
I think overall, in terms of our growth projections, these countries, if you look at weighted growth, these countries do not take a large percentage share of the total growth of the 45 countries that we cover in the report. However, of course, more generally, we take debt sustainability concerns seriously, and that's a downside risk going forward. And I think along with the funding squeeze that we mentioned before, and that's a central topic still going forward for this region and our concerns, it's really the liquidity issue that we're worried about for many of the countries that have repayments coming up that are squeezed in terms of such large share of their revenues going towards interest payments, debt servicing, rather than towards the development needs that the region is facing. More generally, the fund position has always been that we do not assess comparability of treatment. nor do we comment on the adequacy of the comparability of treatment criteria, which is really under the purview of the Official Creditors Committee, the OCC. And of course, this topic is being discussed more generally by the Common Framework creditors and other participants in the Global Sovereign Debt Roundtable, including now during the spring meetings. Now, let me comment, as you mentioned, on the piece of reaching agreement on common framework debt treatment specifically. And there, just worthwhile also pointing out that each case now is really taking progressively less time, as we have seen. And that's very encouraging news. And so we hope that this will also continue in the future. And on the latest on Zambia, as you mentioned, the OCC, in fact, noted that the agreement in principle, in this case with the steering committee of the Eurobond holders, announced on March 25th, 2024, met comparability of treatment. We think there's no widespread debt crisis in Sub-Saharan Africa. Now, debt vulnerabilities are high. Regional debt has approached levels last seen in the early 2000s. And of course, the still elevated, the high borrowing cost that we see are adding to these challenges. But there's also very sizable differences between countries, and there are widely varying circumstances more generally. But what we have seen is that debt levels have broadly stabilized at 60% of GDP, thanks to much of the fiscal adjustment that has been done over the last several years and that countries continue to do going forward, as well as really actively tackling these debt issues head on. So those are very positive signs that we see. And again, we did mention in the report ways of more domestic revenue mobilization, since exactly this outward look, the external financing, what we see remains so costly. So in that way, the countries have to look more inward. But overall, we don't see a widespread debt crisis. Yes, no, very interesting concept. It's still also early days. I think these are somewhat innovative products, and these swaps can play important roles in some circumstances. And we have done some research on this. And based on those findings, they're unlikely to provide a universal solution for countries struggling with debt or confronting climate change or nature loss in those senses. And what's important here to emphasize is that these swaps should not come at the expense of traditional debt relief or concessional finance in particular. So it should be additive. However, they could be scaled up to complement existing instruments and strengthen resilience in countries at the front line of these climate change shocks and loss of natural biodiversity, at a time, especially now, when financing is very scarce and expensive. I think one of our reports last year, in fact, talked about climate finance needs for the region, which is very, very large. Let's keep in mind that Sub-Saharan Africa is responsible only for 2 to 3% of the global CO2 emission, but it really bears the brunt of the burden of the climate shocks and the climate change negative impacts. And the needs that we looked at in terms of adaptation was many, many folds compared to, I think it was $50 billion per year, compared to actually the financing that it's receiving. And this is in addition also to the development needs. And I'm just talking about basic infrastructure, school, health. And so what we really are emphasizing here, that climate needs need to be addressed in addition to these more traditional basic needs that these countries are facing, especially after a pandemic, during which it has endured significant scarring, what we call. So on education in particular, we've done a note now in this round, and we have found that many kids are not receiving the adequate schooling that is necessary for SDGs, that the level of spending in terms of education is nowhere near where it should be. So let's keep in mind also when we talk about financing for climate, that those have to come in addition of these basic development needs. Well, in fact, there are two main aspects out of that. One is the political instability that put a lot of downside risk in terms of the outlook, but also that puts added pressure on many governments in order for them to address security concerns that has to come from fiscal budgets that's already strained and therefore at the cost of development needs and other shocks that these governments have to deal with. The other one is in terms of the increased uncertainty that is created, for instance, by the announcement of the ECOWAS exit, which I think you're alluding to as well. It's still early days on that. We still have to see how it plays out in terms of the actual implementation of that. But at first look, in terms of our preliminary analysis, we think the economic impacts are limited in the sense that these three countries are staying in the WEMU, and therefore the trading is limited with non-ECOWAS WEMU countries there. And also the lifting of sanctions on Niger, I think, has relieved some of the pressures of political instability in that region. But we remain concerned, and we will watch this situation very closely.
And that takes us to the close of our conversation on this episode of Business Redefined. We have been focusing on the latest report by the International Monetary Fund, focusing on Sub-Saharan Africa. Remember, this came also on the back of the just concluded spring meetings in Washington, D.C. We continue to focus on developments in the region to bring you the latest as it happens.